Let's take a break from the intraday action and talk big picture. Yields steadily climbing now for 3 months, around the time where the NASDAQ has struggled to make new highs. So what will bonds mean for the stock market? Let's bring in Ben Carlson, who's done some research on the subject. He's a director of institutional asset management at Ritholtz Wealth Management. Ben, good to have you back on the network here. Looking forward to this conversation. You had a really good post about whether bonds can derail the stock market. So let's go to history first, as I know you like to do in your research, and then maybe talk about what's different now. What does history tell us about the potential for bonds to get in the way of equities?
Surprisingly, rising rates aren't as bad for the stock market as most people think. So in the past, when rates have risen 1% or more, actually, the stock market has been up roughly 20% on average. It's only been down a couple times. It's actually inflation that's bad for the stock market. So if inflation is over 3%, the annual return for stocks is roughly 6% a year. If it's below 3%, it's closer to 16 or 17%. So inflation is the bigger boogeyman for stocks than just rising rates.
So is this because the kind of idea that rising rates mean a good economic environment, things are improving, companies are making more money, the two go together, they work together?
Right. A lot of it depends on why are rates rising in the first place. So some people are worried that, let's say we get some sort of pent-up demand boom following this whole pandemic thing and things go okay. If rates are rising in that case and economic growth is rising, that's a good thing. But I guess what happens is if we overheat, inflation gets out of control, that's when you got to start worrying about the stock market.
So in your analysis, can you take moments where yields are going up and then strip out those where there's also inflation going up? How do those numbers look different when you separate bond yields driven by growth versus bond yields driven by inflation?
Well, the one period people tend to look at is the 1970s. And of course, that's when inflation went crazy. But probably a more apt description here for right now is what happened during World War II. And after World War II, we had all this growth and this huge boom and this huge growth in the middle class. And we had this enormous increase in inflation, but rates didn't actually rise. And it was poor for the stock market. And obviously, the bond market got crushed. But it was kind of like the python eating a rabbit, where it worked its way through the system and that inflation didn't stay. And things ended up going okay. And the 50s were just gangbusters for the stock market. So it could be the kind of thing where we see this one-time jump in inflation. People get worried that the 1970s hyperinflation is coming back, and then it just doesn't happen because of demographics and the trend for rates that we've been in for so long. So it'll be interesting to see how investors would react if inflation ever did come. And actually, I think inflation coming would be a much lower risk than if we had deflation and things just spiral out of control that way.
So what's interesting is there's a variation within the returns. It's not the most linear relationship necessarily between inflation and S&P 500, at least just looking from the table we were at, but you can definitely kind of pick, okay, the very low end of inflation is definitely better than the very high end of inflation. Am I right in kind of assessing that there's a fair amount of variance within the middle of the inflation rates?
Yeah, and it looks like 2% to 3% of inflation is sort of the sweet spot, which is actually where the Fed is looking to target right now. So maybe that's why they're looking there. But yeah, it looks like if it gets closer to 4, 5, 6%, things get out of control. Stocks do much worse. But if we're talking in the 1 to 3% range historically, stocks have done just fine in that situation. And obviously, it's funny to talk about inflation now when the trailing 12 months is less than 1.5%. But obviously, investors look forward, not backwards in these things.
Okay, now in terms of the level of yield or level of inflation versus which direction it's going, it seems like that also is a kind of another part of this that looks maybe more clear. You've broken it down by inflation rate rising versus falling, kind of to make it more simply. And the average is definitely, I have no idea, but it looks like a statistically significant difference between the S&P 500 returns that are like 17% on average when we're falling versus 7% on average when inflation is rising. So what period did you use to calculate this, and what kind of time frames?
Looked back to the late 1920s on this, and I just looked at if inflation is rising or falling from year to year.
Okay.
What those annual returns were. And yeah, if inflation was rising from one year to the next, the average returns were roughly 6% a year. If inflation was falling, and that's not necessarily meaning deflation, but just a disinflationary environment, then stocks were up closer to 17% per year. So it's one of these things where, yeah, the market tends to, like, even if we have some inflation, if it's falling from year to year, not rising.
So where it gets weird right now, Ben, obviously, is that, like always, the precedent doesn't work perfectly. There's always unique things happening right now. The most unique one being that we've had rates so low for so long. And the magnitude is at, zero. The level's at zero. So any move higher in the yield is kind of, if you do it through like a percentage of where it was, it's going to be big. Do we know how that will play in when you move, say, 100 basis points from 5 to 6 versus from 1 to 2? I mean, relative to where we were, such a move in magnitude would be a bigger percent right now. So how does that factor in that kind of rate of change?
That's what I think makes the current situation so much harder to handicap as an investor, because we've never risen from these levels before. So, I mean, people are getting worried that the 10-year is at 90 basis points or 1%. Can you imagine saying that to someone in the 90s or 80s, that people are worried about 1% interest rates? And unfortunately, that's the environment we're in, and people, it's always a relative game, so people anchor to what they know, and the 10-year went under 50 basis points or 40 basis points, so they look at it doubling. It's interesting to see what investors will be willing to deal with in terms of rates and what they view on a relative basis as being very low historically, but maybe a little higher than it's been in recent years.
So we don't really know, right, until we see how this experience goes. In the meantime, the last 3 months, Ben, we've had yields on the 10-year pretty steadily climbing. We've had a lot of different environments actually over this period. We've had speculation that stimulus is definitely coming, then it doesn't come. We've had election volatility in both ways, blue waves, not blue waves. In the summer we had a decent inflation print, but then the last couple ones have been soft. So it seems like right now the 10-year is just kind of moving sluggishly but steadily in a direction right now. What does that mean, do you think, even if inflation does stay low? I mean, what if we have this disconnect where we don't have to get runaway inflation and yields just start to steadily rise? Could that get in the way of stocks that have enjoyed an environment where there's been no alternatives really on the yield front for a really long time?
That could always be possible. The funny thing is we've actually seen these massive flows into bond funds this year on the mutual and ETF side of things. So there's still been a huge demand for bonds even at low rates. So yeah, you would imagine maybe if rates tick up a little, there's the TINA thing doesn't quite work anymore, and there's all these boomers who need yield. So that's a possibility. But again, in the past, when rates have risen, especially for a good reason, that's been a decent backdrop for stocks. It just depends if inflation catches up. And again, it could take a while. Rates could double and get to 2%, and that's still fairly low historically. So a lot of it depends on what investors are willing to call a good yield these days.
Yeah, okay. So it's kind of, we're playing it by ear here because we've kind of in unprecedented territory. I mean, magnitude, obviously the level's still low comparative to where we were. It's an increase. Ben, in terms of assessing this and gauging going forward, how do we do that? I mean, can we look at any of the action in the last couple months and take away any conclusions? Do you think the bond market has played a role in the NASDAQ's kind of struggle to keep up here, as we haven't made new highs in a couple months? Do you think that's factoring in? And if so, or if not, how you gauge the bond impact on the stock market to see if that is playing a role?
I think one of the things that makes it so hard to use the bond market as an indicator these days in terms of yield levels is how much is the Fed doing? So let's say we do get some inflation and the Fed decides we can't let the government deal with higher rates because we need to fund all this debt we're taking on and these deficits. And the Fed just decides we're going to put our foot on the neck of rates and keep them down and keep buying. What does that do to market participants? Does that change the dynamic? If the Fed can really keep rates low, and I don't know if they can, maybe they can. I wouldn't bet against Jerome Powell at this point. So I think the really big wild card these days is just what is the Fed going to do if and when rates rise? And I don't think anyone knows that. So
the possibility of still capping them out, yield curve control and such. All right, well, this is a good setup and I think a really good conversation to keep going. Ben, appreciate you joining us. Really like the research as always. Thanks for being here.
Thank you.
Ben Carlson is Director of Institutional Asset Management at Ritholtz Wealth Management.